The markets are down 15% and your portfolio is bleeding red. While most investors are panicking, what if I told you that this is a golden opportunity? Yes, you heard me right. Over the next 8 minutes, I'm going to explain this phrase a little bit more as to how some of the smartest investors in the world use market downturns to create a great tax advantage for themselves. Welcome to Finsherpa, and I'm Babu Krishnamoorthy. There is a saying that never waste a crisis. I'm going to modify it to say never waste a loss. Yes, my friend, we're going to talk about how loss in a portfolio can be used smartly to offset your tax. And this is called tax loss harvesting. Some of the world's smartest investors use their low performing portfolios in market downturns to sell and exit even at a loss so that they can use that to set off their high performing capital gains, thereby saving a ton of tax. Thousands and crores of monies are saved as tax through this. It's high time we use this too. Now let's understand what is tax loss harvesting. Tax loss harvesting is nothing but using market downturns to sell some of your poor performing portfolios, especially those at a loss, so that while you get rid of the portfolio and convert equity, stock, mutual fund into cash, you're also booking a certain amount of loss. And this loss can be set off against any capital gains that you've already incurred for which you're due to pay tax. As a result of setting off this loss against the capital gains, you end up paying valuable taxes on this. That is what is tax loss harvesting. Let's see how this actually works on the ground. But before we go there, we need to understand some common terminology that works in this space. For instance, when you hold equity stock or equity mutual fund for a period less than 12 months, then the gains or loss incurred is called short term. So it's called short-term capital loss or short-term capital gains. When you hold that security beyond 12 months, then it is called long-term capital loss or long-term capital gains, as the case may be. So based on this, the tax rates also differ. For instance, in India, short-term capital gain on equity and equity mutual funds amounts to 20%. Whereas if you held it for long term, that is beyond 12 months, then it is 12.5% after a base minimum rate of 1.25 lakhs. So up to 1.25 lakhs of long-term capital gains, there is no tax, and beyond that, you pay 12.5%. So that is the rates. I also want to talk about certain amount of set on, set off that is applicable on some of these securities. Short-term loss can be set off against any short-term gain or long-term gain. Similarly, long-term loss can be set off against long-term gain alone. And if you have any losses beyond, you can also set those losses against any business income that you have. So a loss from an income tax standpoint is a very precious resource, my friend. It allows you to set off against a gain and thereby save potential tax outgo from your end. Let's look at a practical example of how one can apply tax loss harvesting. Now let's take the example that Rajesh has a few equity stock. He has bought and held Infosys for the last 6 months, and in those 6 months, the portfolio is showing an 80,000 rupee gain. He also has invested in Reliance, say as an example, and held it for exactly the same 6 months, but it is at a 50,000 rupee loss. So there's a short-term loss in Reliance. He also has HDFC Bank, on which he has held for over 2 years, where the gains are about 2,50,000. Now, assuming this were the portfolio, in the normal course, without considering tax loss harvesting, the normal course of action would be that one would look at short-term capital gain on Infosys. So at 80,000 rupees, that is the gain. On 20% on that, which is the tax, you will have 16,000 rupees that is due to be paid by him. On the long-term capital gain, which is the HDFC stock that he is holding, we noted that it's 2,50,000 that is his gain, on which he gets a set off up to 1,25,000 as per law. The base 1,25,000 is tax free. So therefore, on the balance 1,25,000, he has to pay tax at the rate of 12.5%. That works out to 15,625. So 16,000 plus 15,625 means he has a total liability of 31,625. Now let's take the example that he also wants to use tax loss harvesting to his advantage. Then Rajesh will also use the Reliance Securities loss. First, set that off against the gain that he has from Infosys. So therefore, 80,000 minus the 50,000 loss, the amount is only 30,000. On 30,000, he has to pay a 20% tax, which means the amount of tax that he has is 6,000 only. The long-term capital gains is of course the same calculation of 15,625. Therefore, 6,000 plus 15,625 works out to 21,625. Therefore, as compared to not using the advantage in this example, he is able to save up a solid 10,000 rupees. This is just an example, my friend. The same computation can be used even in case of mutual funds, equity funds, so on and so forth. And the best part is, as long as you do this before the 31st of March, you can always buy back the same. Let's assume Rajesh wanted to stay invested in Reliance. All he needs to do is sell it for the books and then buy it back once again. So when he sells, he uses that loss to set off, but again he buys it back so that he continues to retain in his portfolio. The only other point that one needs to look at, of course, he is incurring two brokerages, right? A very small cost in today's terminology of incurring once when you sell this portfolio and once again when you buy. There is a brokerage additional cost that one incurs. Other than that, I think it's a fantastic deal to kind of recreate that portfolio, yet also incur the loss that can be used set off. Few considerations one must keep in mind. First up is that there is a securities transaction tax. Every time you sell a stock or a mutual fund, an STT applies. So in this example, when you sell, there is an STT, and then after using the loss, you again buy back the same security or something else, you have a double impact of STT. It's a small cost, but it's a cost nonetheless. Next up is that if it's an F&O trade, then F&O is not considered a capital gain but a speculative business income. And therefore, any loss or gain from F&O has to be set off within themselves. You cannot use that loss to set off against a capital gain income. So to that extent, these are separate silos. So one needs to keep in mind whether you're only setting off capital gain income and not a speculative income from that. Third, if you have carry forward losses, you can carry it for an 8-year period. If you have long-term capital loss, you can only set it off against long-term capital gain. You cannot set it off against short-term capital gain. So there are some restrictions on this account that one needs to do. Plus, you have to actually file these loss returns. If you want to carry forward the loss, then you must file these tax returns and you must file it before the due date. If you are delayed in filing, then you forfeit the advantage of carrying these losses. So it must be done within the due date for filing IT returns. It must be done properly as per record. Similarly, intraday trades has to be netted off among themselves. So one intraday resulting in a loss cannot be set off against a long-term capital gain of an asset that you hold as an investment. So those are a few restrictions that one needs to keep in mind. But broadly, if you are an investor, long-term investor, then this is a great way to optimize your taxes as well as keep your portfolio rejigged and going with. This is a tax system that is prevalent in many parts of the world. In India as well, it is allowed. Only thing you need to do is you should not make it very apparent that you're doing it only for tax advantage. So as long as you don't do it at a mass scale and you don't do it only for tax advantage, and you don't arise the suspicion of the IT man, this is a valid transaction that is allowable under the Income Tax Act. I would urge you to, whenever markets are down, to revisit some of your portfolios and see if they are significantly down, whether you can apply this tax law principle. Like I mentioned, the example we've used is an equity stock, but you can use it for mutual funds as well. See if you can spin around some of the loss-making mutual funds and see if you can use that loss to set off against some capital gains on which you are due to pay tax. Save money, save tax. Hope you like the content on tax loss harvesting. If you have such other ideas, do comment on it and write to us, and we'd be very keen to look into it as well. If you need any assistance or more clarifications, please click on the link and register, and we will reach out to you for more.